There are 3 factors about seasonality that can help us profit beyond the stats themselves. We'll talk about all 3 of these, and at the end of the video, discuss how far we believe the S&P 500 can go by year end. I'm Cappelleri from CappThesis, where we identify the market's most important trends and best trade ideas, all through the use of charts. So let's start with what's not important. And believe it or not, the stats are the least important factor of all this. Here's what I mean. We knew that coming into September, the month typically didn't have the best track record. And looking at the last 20 years, that's true, right? Down about 50 basis points, only up about 55% of the time. But again, just looking at that alone does not give us any context, which is really a necessity. So at the very least, we have to see what the other months do around it and see if they're actually much better than September is. And a quick glimpse of that tells us that yes, that is the case. You can see that there are a number of months, especially July, October, November, December, which typically do much better. And January is the only one that's had an average move of down 50 basis points as well, and actually only up 45% of the time. So September, January, typically bad. But we need much more than that, right? If you think about any of the studies we typically hear, the S&P 500 has done this after say 3 or 4 months, 12 months later, it's up 75% of the time, and average 15% as a for instance, right? As active investors, we want to know where the opportunities lie within those 12 months or whatever time frame it is, right? So much more important than the stat itself is actually the path we take to get there. It could be starting at a point where you drop 20%, then rally 30, or vice versa, or maybe just sideways, and that's what it is. So for September, we see this chart from Equity Clock, which does a great job talking about seasonality, is that yes, September typically is lower than when it starts, but in the middle of it, tendency to have a rally. Now this is the average, but it doesn't mean that there were at least some good years in there, what looks like a good rally into at least the middle of the month, and then it comes lower. So that's factor number 1. Factor number 2, the year. Now it doesn't really matter that we're in 2023 by the number, but it is important to realize that 2023 has been an up year, right? And so as that chart just showed before, the average path over the last 20 years is to trend higher. 2023 has been doing that so far. That may be obvious, but last year was the complete opposite, right? 2022 was going lower, so relying on seasonality that typically shows a positive outcome in a year that's moving lower wasn't really that helpful at all, right? So it's important to know. Now this is especially true over the last 2 months, right? And so this past July of 2023, we know we had a rally, faded by the end, that gave way to a decline for most of August, which then ended with a rally. And that looks very similar to, again, the 20-year average path, which also showed a rally in July, it faded at the end, gave way to a decline in August, and then saw a last-ditch effort, which then led to a buying opportunity toward the end of the month. And so if all that played out again, then we can see how this would look, where again, a top in July, a bottom in August, another top in September that then produces a potential higher low, which can then possibly be taken advantage of, which we'll get to at the end of the video. So it's also important to realize what part of the presidential cycle that we're in, right? And right now we're in a pre-election year. And this is now looking at the Dow Jones Industrial Average going back over 90 years. So much more data in there. But typically, same type of thing where you have a little bit of a rally to begin the month and then a fade by the end. But that's actually much better than the average path of all Septembers going all the way back, again, over 90 years, where typically is lower for most of the month. So you have positive trend for the year. You also have relative strength in a pre-election year. That's important as well. Before we get to the most important factor, if you like this kind of content, subscribe, and you'll be notified every time we put out a new one. Tell us what you think. Is seasonality important? Is it meaningless? Whatever it is, we want to know. Put it in the comments. Factor number 3, the trend. Now we talked about this a little bit in terms of what the year has been, so we have to drill down a little bit more. How is an uptrend created? Uptrend is created by the ability of the market to form bullish patterns, break out, and have the pattern targets achieved, right? Sounds simplistic, but again, that didn't really happen in 2022, which was a major reason for the pullback. And so here's an example. The first major breakout we saw this year was at the end of March, right? And that extended all the way until achieving the target at the end of May. So not right away, but it worked. Most importantly, the breakout zone wasn't violated. And that gave way to a much bigger pattern breakout at the end of May. And that brought us all the way to the end of July, by the time that the S&P finally achieved that target there. Now, what's also evident from this is that we're very extended as July ended. So that also means that we didn't have any more bullish patterns playing out right then. We had to wait. So that means we had to at least see some sort of pullback, some consolidation for the next one to potentially form. And really that's why the pullback in August didn't seem that negative from that perspective. We needed something like that to occur to have the next foundation potentially constructed to then take advantage of, right? And so if you look at this more bigger picture, right, it took about 3 months from the February high to the May breakout. And so we just topped out in July. So believing that it's going to come all the way back and break out again, it was probably presumptuous, probably needs some more time. And if we can continue to consolidate, and if within that time frame the carnage isn't that bad, then that could set up for the next breakout attempt potentially in the fourth quarter. So what's next, right? 2023 has been higher. S&P has been able to take advantage of breakouts that we just talked about, but it hasn't been straight shot higher, right? There's been a 9% pullback in February and March, another 6% pullback from July to August. So far, those dips have been bought. And if, again, the weakness doesn't get any worse, that will then cause investors to potentially start to buy at higher prices. And if that occurs, then we can see something like this playing out. Going back to the original chart showing the 20-year average, where you typically get a very good run in the last 2 months of the year in the fourth quarter. Now, why is that, right? Psychologically, we can understand it. It's FOMO, fear of missing out. Investors understand that they actually have to chase now. Maybe there won't be as many pullbacks. But beyond that, we're talking about real big financial institutions that manage money, billions of dollars for people. They're waiting for pullbacks as well. If they don't get them, then they have to keep pace with the benchmarks, right, that they're measured against. They want to provide their clients the best returns possible. And if they feel that they're not going to get an opportunity to get involved at lower prices, they will continue to buy as well. And obviously that is what really drives the market going higher. And that is the correct way to use seasonality. Now beyond this, we have plenty of other videos here, long form, short form. Check them out. Let us know what you think, and talk to you next time.